In this video we are going to explore different concepts on accounting treatment for inventory, such as sales return, purchase return, carriage inwards, carriage outwards, perpetual and periodic system, different inventory costing methods such as the first in first out, and the weighted average. If these are what you've been looking for, then stay tuned. In our previous clip we have gone through the concept of an income statement. However, sometimes when customers are not happy with our products or service, they will ask for return of their money, and we call it sales return, and we have to record this item in our income statement. To record sales transactions, we debit trade receivables or cash, then credit sales. By the way, if you're not familiar with the double entry system, don't hesitate to watch our previous clip on accounting basics. But if you're okay with it, let's move on. For sales return, we debit return inwards, which is a profit and loss account item, and credit trade receivables or cash to reverse the amount in the asset account. Same logic goes for purchase. To record purchase we debit purchase, which is a profit and loss account item because the inventory was bought for trading purpose, and credit cash or trade payables. However, if we want to cancel the transaction then we need to make a purchase return this time. We then debit cash or trade payables and credit return outwards, which is a profit and loss account item. Another thing that baffles us should probably be the transportation cost of either delivering goods to customers or from suppliers. To solve this problem, we should first understand the terms carriage inwards and carriage outwards. Carriage inwards is the shipping or handling cost that the company should recognize as part of the purchase. Therefore, if the purchase is settled by cash, then we should debit carriage inwards, which is a profit and loss account item, and credit cash. As for carriage outwards, it refers to the shipping or handling fee that the company has to pay when the company is shipping goods to customers. This time we should treat it as other expense and debit carriage outwards and credit cash. Now let's go back to our income statement format. This is what an income statement basically looks like, but after we put in the terms that we just learned, the income statement should look like this. We'll have return inwards after sales, and carriage inwards and return outwards as part of our cost of goods sold, and finally carriage outwards as other expenses. So this should be a more complete format of our income statement. But wait. If inventory is a balance sheet item, then why didn't we see it in our double entries? The reason is because there are two types of inventory systems. Namely the periodic system and the perpetual system. And we are using periodic system in our examples. The periodic system requires the company to perform physical count of inventory to track the beginning and closing inventory within an accounting period. However, the perpetual system requires more recording effort because it requires the company to keep track of its inventory on a per sale basis. Now let's take a look at the double entries for periodic system. To record purchase transactions on credit, we debit purchase and credit trade payables. Then, when we settle our liability we debit trade payables and credit cash. When it comes to the end of the accounting period, we first credit the opening inventory, then credit the purchase account. Since we know the inventory record because we will perform physical count at the end of the accounting period, we can then calculate the cost of goods sold, which is a balancing figure in this case here. One of the differences between these two systems is that, in a perpetual system, we use the inventory account directly to make double entries. When company purchased inventory on credit, we debit inventory and credit trade payables. To settle the liability we debit trade payables and credit cash after the payment. When company sells the inventory to customers on credit, we debit trade receivables and credit sales. Unlike the periodic system, this time we'll make another journal entries to transfer the cost of inventory from the inventory account to the cost of goods sold account. We credit the inventory account and debit the cost of sales account. At this moment you might wonder, when we track record of our inventory, what if the cost and the selling price after deducting handling fee are different? In fact, according to the international accounting standards, inventories have to be measured at the lower of cost and net realizable value. Meaning that if the inventory was purchased for $10, but by the time when the company tracked the inventory record the net selling price drops to $5, then the company shall record $5 as the value of the item. Basically there are three methods of determining cost of inventory, namely first in first out, last in first out, and the weighted average cost. However, since the international accounting standards do not allow the last in first out method, we shall focus on the other two. The first in first out method assumes inventory are issued out in order in which they were delivered into the company. Whereas the weighted average cost method uses the average price for all units in inventory. Now let's have a look at our example. On 31st December 2018 the opening inventory is 1, cost per unit is 80, so the total cost is 80. 1 month later the company purchased 2 units at a cost of 85, so the total cost would be 170. Then in March, the company made a second purchase of 2 units at a cost of 87, and this time total cost of purchase is 174. In April, the company sold 1 unit. In December 2019 the company made another purchase of 1 unit at a cost of $90 per unit, the total cost of purchase is then 90. If we add up the total cost we have 514, and total goods available for sale in this year will be 6. If we use the first in first out method, both periodic and perpetual method give us the same cost of goods sold because both of them will sell the unit that first entered the inventory record in the accounting period, which is the unit at the opening. However, since the weighted average cost is made at the time of purchase in perpetual system, therefore cost of goods sold could be different when using the average cost method. The periodic system would use the total cost divided by the total goods available for sale at the end of accounting period, which gives us 85.7, but the perpetual system would calculate the average cost in April when the company sold the inventory to customer, which gives us 84.8. So that's the end of this video. Thanks for watching. Remember to like, share, and subscribe. See you next time.